As I said on Friday, I expected a lot more banks to fail in the coming week had the government done the right thing and allowed the Silicon Valley Bank to fail. And I mentioned on Friday that there was no way this was an isolated event, that more banks would follow. And sure enough, over the weekend, another bank, Signature Bank, also failed, that is now owned by the government through the FDIC. So that makes 3 banks that have failed. All these banks, very related to tech and crypto and things like that, but they're not unique in what they've done. There are so many other banks that are in trouble or were in trouble until this massive bailout was announced on Sunday evening, about a half hour after the futures market started to open. So really that was their goal, right? They wanted to get this under the wire. It was, the 9th hour, and they wanted to make sure the markets got the good news that the government was going to do this big bailout. Of course, everybody is claiming that it's not a bailout. Listen to President Biden, gave a speech today, and all these minions are out there. Oh, this isn't a bailout. Nobody's getting bailed out. This isn't like 2008. Nobody wants to admit it's a bailout because obviously the bailouts were not popular. And so they want to distance themselves from that language. But this absolutely is a bailout. And also you got Joe Biden today saying, don't worry, the taxpayers aren't going to pay anything for this bailout. Okay, well then where's the money going to come from? The man in the moon? Of course the taxpayers are going to pay, but they may not pay in the form of taxes because nobody has the integrity to actually raise middle-class taxes. But that doesn't mean the taxpayers are going to get away with this. They're going to pay for it. It's just that they're not going to pay for it with higher taxes. They're going to pay for it with higher prices. Now, they also might have higher costs when it comes to their checking account or using their bank, but that's going to pale in comparison to the explosion in the overall cost of living. The bailout is being paid for by inflation. In fact, as far as I'm concerned, today marks the return to quantitative easing. So we are now officially in QE5, and I expect the Fed's balance sheet to go up from here. By the end of the year, it's going to be above 10 trillion. It's going to be much higher than it was when they started quantitative tightening. They started it, but they can't finish it. That's another one of the predictions that I made. I also predicted that if the Fed tried to raise rates high enough to fight inflation, before they succeeded in bringing down the inflation rate, they would bring down the economy, and that's exactly what happened. It's amazing. So many people out there were debating whether or not the Fed could pull this off without even causing a recession. People were talking, would it be a hard landing or soft landing or no landing? I mean, even a week ago, Powell was talking about how great the economy was, how strong the labor market was. Yeah, we're going to keep on hiking rates and no problem. Well, I said, not only was everybody wrong, not only could the Fed do this and avoid a recession was inevitable. What I said, it wasn't going to be just a recession. I said the only way the Fed could succeed in attempting to bring inflation down anywhere near 2% is by creating a financial crisis. So it wasn't just that we were going to have a recession, we were going to have another financial crisis. And I also said that the financial crisis that the Fed was going to create this time would be worse than the one that it created in 2008. And that's exactly where we are. I said, if the Fed did the right thing and just let these banks fail and let all the uninsured depositors lose their money, which is 95% of the depositors of these banks were uninsured. These are huge deposits from major corporations, very sophisticated investors had a lot of their money in this bank, and they were going to lose it, a good portion of it. Now they're not. Now Biden is making a big deal, and the Fed is saying, well, it's not a bailout because we're not bailing out the management of the companies. They're losing their jobs. We're not bailing out the stockholders. They're getting wiped out. They're losing all their money. Yes, that's true. There's a small number of people who are not participating in this bailout. but there's a lot of people who are getting bailed out, starting with the customers of the bank. They would have lost money, but now they're not going to lose money. Why? Because the government is going to make up their losses. So somebody's got to pick up the tab for that. Now, a lot of people might think, well, the customers, it's not their fault. Why should they lose money? Well, they made the mistake of putting their money in this bank knowing that their deposits were not insured. I'm not talking about mom and pop who had $50,000, $100,000, even $250,000 in the bank. They were going to get paid anyway because they had the FDIC insurance. Of course, that was a mistake. There should be no FDIC insurance. That was just another bad policy of the New Deal, courtesy of FDR, because of the Depression. You had all these bank failures during the Depression. But as I mentioned on my last podcast, with all those failures, it was only about 2% of the bank deposits that got lost. That was nothing compared to what's getting lost now every year with inflation. Remember, we didn't even have any inflation back then. We had deflation. But at least the guys down in the 30s, the congressmen that were around back then, and Roosevelt, at least they had the good sense of having a limit on the coverage. Because what they thought was, the average guy, the butcher, the baker, the candlestick maker, he's not sophisticated enough to know the good banks from the bad banks. So we just want to say, look, any bank that you put a little bit of money in, don't worry, it's safe. The government's going to guarantee it. But for all the larger depositors, corporations, more sophisticated, knowledgeable, you guys need to be the cops here. You need to police these banks and only put your money in the sound banks and avoid the unsound banks. And, the little guys can kind of ride on your coattails maybe if they even care. But they thought that the moral hazard wasn't going to be that bad because only a small percentage of the deposits were covered. And they thought that the broader non-insured deposits would make sure that the banks competed on soundness, on safety, and not just, who had the highest yields. Well, now what the government has done, and I talked about this on the last podcast, is they have removed that. And in fact, the $250,000 limit, which was in effect, went into effect in 2008. During that financial crisis, the government just unilaterally increased the deposit insurance from $100,000 to $250,000. Well, this financial crisis is already so much worse than that one that they've taken the $250,000 and they've made it unlimited. Right now, it doesn't matter because they've just set the precedent. I know they haven't codified it into law, but they've just set the precedent of bailing out the depositors of these two banks. And so now I'm sure that equal treatment under the law, pretty much every major depositor at every bank now assumes that their deposits are insured. So with the wave of a wand, the government just took on an extra $7 trillion in unfunded liabilities, because I think there's about $7 trillion of bank deposits that were uninsured. So now the total number of insured bank deposits is $18 trillion, and the American taxpayer, non-taxpayer, it doesn't matter, you're an American citizen, you are on the hook for this. Because let me explain what the Fed is doing. And contrary to the way it's being portrayed in the media, it is a big bailout, and it's going to cost everybody a lot of money. Again, the way the costs are going to be socialized throughout the population is through inflation.